Hey guys, Credit Shifu here. So the tax bill has passed the House and the Senate in its final revised version. That's kind of a compromise between the two earlier bills that were passed. President Trump hasn't signed it yet, but will be signing it, I'm sure, by the end of the year. So let's take a look at what is in the final version of this bill. And there is a huge amount in it, so we probably won't make it through all the stuff, but let's just take a look at some of the key points. So first of all, we have a corporate tax rate that has been lowered to 21%. This is for corporations, large companies. The US's corporate tax rate previously was 35%, which is actually pretty high. The UK is around 20%. Germany is around 28%. And the average for the industrialized world is around 20.5%. So the US was pretty high, and it's not really very competitive. Trump originally in his campaign, he wanted to lower it to 15% to match China. China has actually two corporate tax rates. One is 25%, one is 15%. 15% is for certain key businesses, but a lot of businesses do access that 15% rate in China. So Trump wanted to match that rate. Of course, that would lower revenues quite a bit, so they compromised. First, they passed at 20%, and in the final bill, it was 21%. And this is a great thing for businesses because it will make the US a lot more of an attractive location for businesses to locate. Already the German business community is worried, and politicians in Germany are quite worried that it will lead to a less investment in Germany, which is the second biggest exporter in the world after China and Europe's biggest economy, and a lot of that investment will go to the US instead, which is already more competitive than Germany on every other aspect except for its corporate tax rate, and now its corporate tax rate is lower than Germany. So let's go to the next category, and that is that the Obamacare Mandate, the Affordable Care Act mandate to buy healthcare, that forces Americans to buy healthcare or else face a fine of something like 2.5% of your salary, or a maximum of $2,000 a year. So this mandate has been repealed. So you are no longer forced to buy health insurance. Now, this will be viewed as a great thing by some people who are young and healthy and who just don't want to buy health insurance. But by others, it may not be viewed as such a great thing. Personally, I don't mind being forced to buy it because I think that if I'm not forced to buy it, I may not buy it. And, it's better to be insured in the very tragic event that something could happen to you. And you could walk out of your house and get hit by a car tomorrow and not be covered. Now, another aspect of this is that hospitals have to treat you in an emergency room if you have some life-threatening illness or injury, but they just have to basically keep you alive, do the bare minimum to keep you alive, but they'll bill you for it, right? So if you get hit by a car and break your leg or whatever, they'll treat you in the emergency room, set your leg, and then send you a bill. And if you're too poor to pay for it, then the hospital may lose out on that, and they have to bill that cost into the price they charge everyone else. So it really is terrible to have people who aren't insured, not just for those people, but also for the other people who are insured, because it drives up costs for them. So, I know some people will be happy about it, people who support freedom, and don't like socialism. Myself, I'm kind of on the fence about it, because, I don't like socialism either, but I still think, well, it's good to have it there so that it doesn't drive up the cost quite as much for everyone else. But, we'll see. We'll see what happens. There are still going to be 7 individual tax brackets. Originally, Trump wanted to bring it down to 3, and then they changed it to 4 in the original House bill. The compromise they've reached between the House and Senate is there are still going to be 7 tax brackets for personal income tax. I'm not going to read off every bracket, but I'll give you a couple of key points. The lowest bracket stays at 10%, all right, for the lowest earners. And that's quite significant because originally the lowest 10% bracket and the second lowest 15% bracket were merged into a 12% bracket. So people on the lowest salaries were actually pushed up. They were actually forced to pay more. Even though the personal exemption, the standard exemption has increased to $12,000, it kind of looked like people on the poorer end of the spectrum are paying more, and that's never good. You don't want to raise taxes for the poorest people, okay? That's just a nasty move. So I think it's great that they've kept that 10% bracket. They've also lowered taxes for the richest people from 39.6% down to 37%. Now I know, some people are going to be annoyed by that. Sorry, my dishwasher's on, so some people are going to be annoyed by that, say, oh, you're lowering taxes for the rich. Actually, this tax plan lowers taxes in almost every bracket by a couple of percent. So it actually lowers taxes for everyone. And of course the rich are included in that. So it does lower taxes for the rich, but it also lowers taxes for the poor. So, I think it's alright. The individual tax cuts expire in 2025. And that's kind of interesting because that's a date when the Democrats may have come into power by then, and a new Democratic, presidents normally serve 8 years, right? I anticipate Trump will probably serve 8 years, 2016 to 2024. In 2025, potentially, a Democratic president will be coming into power, and the first thing he or she is faced with is these tax cuts are expiring. And they're going to be pretty unpopular if they don't extend them and they raise everyone's taxes. So it's kind of a sneaky strategy there. You can see the Republicans probably have done that on purpose to give the Democrats a challenge in 2025 if they secure the presidency and the House and the Senate. Kind of interesting strategy. Another thing is the expanded child tax credit. It's now expanded to $2,000, and that makes up for losing the $4,000 deduction for every household member, every member in your household. And so it makes up to that to some degree. This also expires in 2025. Now let's have a look at the pass-through business rate, because this is something that has been talked about, and it was changed. Originally, Trump wanted a maximum pass-through business tax rate of 25%. Now, some small businesses had protested because the problem with this was that many of these small businesses weren't even paying tax in the 25% bracket, right? And sorry, let me just explain a pass-through business. This is like an LLC or a sole proprietorship, a partnership, where you don't pay tax as a corporation, but your business isn't taxed. Your business's profit goes through onto your tax return and is taxed at the personal rates on your personal tax return. So Trump wanted this maximum tax rate of 25%. The reason he wanted it is because these small businesses can create jobs, and so he wanted an incentive for people to create these small businesses, which then start creating jobs. If you run a store or a farm, you're going to employ people, etc. So that's kind of the idea. It's an incentive for people to start their own business. But the problem with the 25% maximum was many of these businesses, these small businesses, would have been in the 15 or 20 or 25% rate. Not many of them, I think it was 70% of them, were not paying tax at a higher rate than 25% anyway, so they wouldn't benefit at all. So what they've now done is they've introduced a 20% deduction. They scrapped the 25% thing. Instead of that, they've brought in a 20% deduction. So you can now deduct 20% of your earnings for an LLC or other type of small business, pass-through business it's called. So 20% of your earnings from that business will be non-taxable. So if you're earning $100,000, that's $20,000 you can earn tax-free before you have to pay any tax, and I assume that's in addition to the standard deduction of $24,000. So that would be, if you're earning $124,000, first 24 is tax-free, and then you get another 20 that is tax-free as well. I assume it's in addition to the standard deduction. If anyone knows, please leave a comment. I'd love to find out 100% for sure that this LLC deduction, this pass-through business deduction, is in addition to the standard deduction. So in theory, if you're earning $200,000, then you get the 40% tax-free. If you're earning $300,000, you get $60,000 tax-free, and so on and so forth. So it means that businesses at every level of income get the first 20% of their taxable income as a 20% deduction. And I think that's great. And my company is an LLC, the company that runs this YouTube channel. So we're definitely not paying tax at a higher rate than 25% because we don't earn that much. So we'll definitely benefit from this 20% deduction. So for me, I think that's a really great policy. And I think it's really great that they listened to what small businesses said, that the 25% thing would only affect the richer businesses, and they changed it. I think that's really awesome. Let's have a look at a few few more things. There's changes in the US tax system, moving to a territorial tax system where companies are not taxed on foreign earnings, and they are also allowing companies to bring back cash that has been sitting overseas, to bring that back at the one-time low tax rate of 15.5% for liquid assets and 8% for illiquid assets. And I think that's really great, and doing a territorial tax system brings the US in line with quite a lot of other countries in the world. They added a clause that allows them to drill for oil in Alaska. That's obviously something that was added in. Probably it was a compromise. You know, some senator was like, I don't really want to support this bill, but you know, I want to drill for oil in Alaska. I'll support it if you add in that clause, you know? That happens a lot with stuff in the US where they sneakily add in amendments to bills for things that are unpopular, but they want to do them anyway, you know? And they use this to coax senators on congressmen who don't want to vote for it and say, hey, you know, we'll let you have this, we'll add this amendment if you vote for it, even though you don't like the bill. You know, so make of that what you will. Like we said, the standard deduction has increased from $6,700 to $12,000 for individuals, and married filing jointly, it's a $24,000 deduction. There are also a few other minor things. So you can now deduct a maximum of $10,000 in state taxes, income and property taxes. Previously, you know, they previously wanted to do it so that you couldn't deduct any state taxes, but that was kind of protested basically from people in California, New Jersey, and New York, which are the states with the highest, you know, highest taxes, especially property taxes in New York and New Jersey are insane. And, you know, I think Trump canceled that, he originally wanted to cancel that deduction so that states would have to be more competitive in their taxes, in, you know, lowering taxes to compete with each other and to drive states away from socialism as well. And, you know, I think he sort of realized that people in these three very rich states would lose out, so they did a compromise again. So you can now deduct a maximum of $10,000. There's another rule which I'm quite pleased about, which was dropped. They were originally trying to bring in this first in, first out rule for individual investors, where they would force you to sell, if you bought shares in a company over a period of time, if you wanted to sell some of those shares, you would be forced to sell the first ones you bought, irrespective of what price they were bought at. And you know, that could be disadvantageous to you if those were the ones that you had, well, they probably would be the ones that you bought at the cheaper price if they were the ones you'd bought historically further into the past, because in general, stock markets and companies are moving upwards. So that would force you to sell the shares you bought at the cheaper price, which will give you the largest capital gains tax bill. So, and that was kind of sneaky, and it was even more sneaky because it was only for individual investors. It was not for institutions. So it was an attack on kind of like the small investor, but they cancelled it. So I'm really pleased to see that they cancelled that that little, you know, amendment to the bill. Overall, I'm reasonably pleased with the bill. I think it's okay. It's not perfect. Likewise, you know, you can see they had to, you know, compromise a lot with, you know, for certain senators to get them on board. They added in that oil drilling in Alaska thing, and the I think it's a wildlife refuge. Yeah, Arctic National Wildlife Refuge. They can now drill for oil in. You know, some people will definitely be pleased. The oil industry will be pleased by that. Probably environmentalists will not be pleased. Hopefully it doesn't end in disaster with a big oil spill. But in general, I'm pretty pleased with the bill. I think lowering everyone's taxes, that's a really great thing for everyone. Hopefully the child benefit does make up for the cancellation of the personal deductions that you used to get, $4,000 for every person in your household. I believe it will probably lower my taxes a little bit, not hugely, but a little bit. So I'm willing to give it a go, and I'm excited to see what it is like in 2019 when I go and file taxes, obviously, because it's going to start from January 1st. So please leave your comments in the comments section below. What do you think of the tax bill? Do you love it? Do you hate it? All opinions welcome. Let's have a debate and a chat about it. And I want to wish you guys a very Merry Christmas. Subscribe if you're new. Give this video a like. And we'll see you in 2018.